Hello, everyone. We'd like to welcome you to today's webinar. That is the first in a series of webinars to take place for the ADIT Cyprus community. The ADIT network continues to grow by supporting ADIT students and affiliates, making the ADIT qualification a global certification amongst the tax profession. Having said that, I take this opportunity to introduce to you today's speaker, Michael Grekas. Michael is a board member at KPMG Cyprus in charge of VAT services. He has a long experience in dealing with indirect tax matters and tax technology. Michael will be discussing VAT in the digital age and the European Commission's recent proposals to modernize the EU VAT rules. And prior to Michael starting the presentation, I give the floor to Rory, who can discuss with you further. Thank you.
Thank you very much, Katya. And as our champion for our Cyprus community, our thanks to you for organising this webinar, which will hopefully be the kind of first in a series of dedicated ADIT webinars for our growing community across Cyprus. It's one of our largest communities of ADIT students and affiliates and ADIT holders around the world. So we're tremendously keen to do what we can to support international tax professionals in Cyprus in their ADIT qualification and their ADIT studies while they're students with us, but then beyond that in their further international tax careers and to support them with initiatives like this. So we do have Michael coming up, Michael's presentation coming up, but if you have any questions, if anybody has questions at any stage for Michael on any of the topics that he talks about, you can put your questions in via the Q&A function and the chat box. There you can just type in your questions. You can do it but whenever you're ready to pose a question. You don't have to wait till the end, and the questions there will be stored and Michael will be able to answer those at the end of his presentation. So without further ado, it's my pleasure to introduce Michael, our speaker today. Thank you.
Thanks for the introduction, Katya, Rory. I would like to thank you and also ADIT, especially for the invitation. And I really hope that this series of webinars will be a great success, and wishing you all the best for the future ones. Okay, so I think we can start. Can you see my screen? It's okay. Yeah, perfect. So our today's subject is VAT in the digital age. On 8th of December 2022, the European Commission published its legislative proposals in the framework of the VAT in the digital age initiative. Basically, in order to modernize the VAT system by adopting and using technology, with the aim to reduce non-compliance and combat VAT fraud. It is an ambitious plan. It contains ambitious VAT reforms, including an extension of the current one-stop shop, the OSS, and some other measures we'll see later on to reduce compliance costs for businesses. So let's see the reasoning, first of all, behind all this, where they're coming from, and the objectives of the proposal. As you may already know, VAT is one of the main revenue sources in all EU member states. It is a key source of financing for the EU budget, since 0.3% of VAT collected at national level is transferred to the EU as own resources, and this represents 12% of the total EU budget. So we all understand the key importance of VAT in budgetary policy making. However, the VAT system is vulnerable due to weak, let's say, VAT collection and control methods, But equally important, the VAT system imposes excessive burdens and compliance costs. The VAT gap for 2020 was estimated at 93 billion euros, mainly due to missing trader intra-community fraud. The VAT gap also includes revenues lost due to domestic VAT fraud and evasion, VAT avoidance, bankruptcies, and other administrative errors. So the VAT system is not only prone to fraud, but has also become increasingly complex and burdensome for businesses. In particular, the VAT rules for cross-border trade, which are like 30 years old now, are not compatible and adapted to doing business in the digital age. That is the reason, the main reason for considering how technology can be used to reduce administrative burdens and related costs for businesses, and at the same time combat VAT fraud. Therefore, in its 2020 action plan for fair and simple taxation, supporting the recovery, the Commission announced the legislative package, the so-called VAT rules for the digital age, which was also included in the 2022 Commission work program. Now, this proposal has three main objectives. Firstly, to modernize the VAT reporting obligations, and this will be achieved by introducing the so-called digital reporting requirements, which are to be enacted gradually from 2025 to 2028. These new requirements will basically standardize the information that needs to be submitted by taxable persons on each transaction to the tax authorities in an electronic format. And at the same time, the use of electronic invoicing, E-invoicing, for cross-border transactions. And this will be mandatory and not optional anymore. Secondly, to address the challenges of the platform economy, when we say platform economy, we mean the term relates to supplies of services made via a platform. And again, how these challenges will be addressed by updating the rules, the VAT rules applicable to the platform economy, clarifying the place of supply rules applicable to these transactions, and enhancing the role of the platforms in the collection of VAT when they facilitate the supply of short-term accommodation services or passenger transport services. And finally, the third objective is to avoid the need for multiple VAT registrations within the Union and improve the mechanism to declare and pay the VAT due on distant sales of goods by introducing the single VAT registration. This will be achieved by improving and expanding the existing OSS and IOSS. By the way, OSS is the one-stop shop and the import one-stop shop. And also the reverse charge in order to reduce cases whereby under which a taxable person is required to register in another member state. Now let's see briefly why these changes are required. First of all, with regards to the first pillar, let's say, the digital reporting requirements and E-invoicing, the electronic invoicing. Well, the current default reporting requirements are not digital because the VAT directive dates from the 70s. However, the global trend shows a move from traditional VAT compliance towards real-time sharing of transaction-based data with tax administrations, which is often based on E-invoicing. We should note that member states need to obtain a derogation as for them to be able to adopt digital reporting requirements based on obligatory E-invoicing. Hence, the VAT directive represents at the moment a significant barrier towards digitalization. Nevertheless, and as many of you may know, many member states have already introduced or planning to implement different digital reporting obligations domestically. And the measures have proven to be successful in those member states in increasing the VAT collections. And this is mainly due to the improvements in tax control and the deterrent effect of non-compliance. Just to mention some statistics here, that the Commission estimated that the increase in VAT revenue from 2014 to 2019 on those member states was between 19 billion and 28 billion euros, corresponding to approximately an annual increase of VAT revenue between 2.6 and 3.5%. So the VAT directive grants the discretion to member states to introduce obligations they deem necessary to ensure the correct collection of the tax and to prevent evasion. Therefore, digital reporting requirements vary substantially from one member state to the other. This may consist of transmission of monthly reports of business transactions, real-time submission of invoices, real-time or quasi-real-time transmission of invoice data, and also the submission of tax and accounting data, or even VAT records. It is also noted that some member states have implemented non-digital tools for reporting transactions. And by the way, all these requirements are in addition to the requirement to submit VAT returns. So this individual, let's say, uncoordinated approach by various member states in reporting obligations created substantial new compliance burdens for businesses operating across the EU, and increases the risk of fragmentation and as such hindering the operation of the single market. Another main issue has to do with the outdated recapitulative statements, also known as VS statements. The current recapitulative statements date from 93 and have not substantially changed since then. And so you can easily understand that they are not fit for the digital economy and cannot be compared to the much more modern digital reporting systems that have been implemented by some member states for domestic transactions. Moreover, these recapitulative statements, they only provide aggregated data for each taxable person and not transaction by transaction data. Also, they do not allow data from suppliers to be cross-matched with that of acquisitions, as the VAT directive leaves the reporting of intra-community acquisitions optional for member states, and very few member states, I think less than half, have introduced this obligation. So basically these issues will be solved by introducing a transaction by transaction reporting system that will provide information to member states in almost real time. So what's gonna change? The current recapitulative statements will be replaced with a digital reporting requirement system for intra-community transactions. Under this system, information will be provided faster on a transaction by transaction basis and with higher quality. That information will feed into the risk analysis systems of the member states to help them counter the VAT frauds linked in particular with intra-community trade. These digital reporting requirements for intra-community transactions will cover the same transactions that were covered by the recapitulative statements, with the exception of the call of stocks, which they will cease to exist. And we'll see later on further details on this matter about call of stocks. So the main features of the new digital reporting system are basically the following. First of all, the information have to be transmitted on a transaction by transaction basis. Another important thing is that the deadline for the transmission of the data is 2 working days after the issuance of the invoice, or after the date the invoice should have been issued. So we are talking here about a quasi real-time reporting. The transmission of the data has to be carried out electronically, and of course member states will provide the means for that transmission. And finally, the information can be submitted directly by the taxable person or by a third party on their behalf. Moreover, we have some additional information that has to be submitted for each transaction. Basically, this information is the same that had to be submitted in the current recapitulative statements, but detailed for each transaction instead of aggregated by customer. And also we have some new fields that have been added to improve the detection of fraud. These new fields are the reference to the previous invoice in case of rectification of invoices, the identification of the bank account into which the payment for the invoice will be credited, and the dates agreed for the payment of the amount of the particular transaction. Member states will also have the option to extend such digital reporting requirements to local supplies as well. However, this will be according to the EU DRR standardized requirements, and this is to align with the digital reporting system designed for the intra-community transactions, so simplifying compliance to taxpayers, which will be able to provide with a common format the data required for both domestic and intra-community transactions in any member state. However, the main difference here is that any domestic reporting DRR requirements will be optional. On the contrary, intra-community transactions will be reported by using the DRR. Now, with regards to the electronic invoicing, we should note that e-invoicing will be the general rule for the issuance of invoices. Currently, you know very well that the issuance of electronic invoices is subject to the acceptance of the recipient. However, this will not be the case under the proposal, since electronic invoicing will be the default system for the issuance of invoices. So taxable persons will always be allowed to issue electronic invoices according to the European standard. Another important addition is that now we have the definition of electronic invoice in the VAT directive, and this definition is changed to align the concept with the one on electronic invoicing in public procurement, which relates basically to the electronic invoicing in B2G transactions, B2G, business to governments. Sorry. So as a result, when referring to electronic invoices in the VAT directive, reference will be made to structured electronic invoices. The use of paper invoices will be limited to exception cases, and this must be authorized by the relevant member state. Now again, the deadline for the issuance of invoices on intra-community supplies will change. Currently, in the case of an exempted intra-community supply of goods and for services supplied by non-established taxable persons subject to the reverse charge, the VAT directive provides for a deadline to issue an electronic invoice, and this deadline could take up to 45 days from the moment the chargeable event occurred. However, the new reporting system, which is built under the philosophy, as we said previously, of real-time information, such deadline will, the current deadline, will delay excessively the arrival of the information on those supplies to the tax administration. And so for that reason, now Article 222 in the VAT directive sets up a deadline of 2 days after the chargeable event takes place for the issuance of invoices in these cases. So an electronic invoice must be issued within 2 days. And also, as we've seen previously, again, these 2 days, let's say, deadline to submit this electronic invoice in the DRR will be obligatory. Another important amendment is that we'll not have any summary invoices anymore. So there will be no possibility to continue issuing summary invoices, as this goes against the aim of the almost real-time reporting system. With regards to the content of the e-invoices, the reporting system, and as we said, in an aim to minimize the administrative burden for taxable persons, so the reporting system will take advantage of the issuance of an electronic invoice to automate the process of reporting. And in order to include in the invoice all the information required by tax administrations, there are additional data elements added to the required content of the invoice, such as the identifier of bank account, detailed payment data, and identification of the initial invoice for invoice corrections. Okay, so now let's move on to the second pillar, which is again very important, which deals with the VAT treatment of the platform economy. We've seen over the last years that the business world is changing rapidly, and online sales models are now the new normal, even in traditional business sectors like passenger transportation and accommodation rental. So the rise of the so-called platform economy has triggered new problems for the VAT system. And one of these problems is VAT inequality. The taxable person status and the exemption for small businesses are two main issues which basically affect the VAT inequality. Until recently, private individuals and exempted small enterprises were not considered to have any impact on market competition with VAT registered businesses. But the platform economy has introduced new business models that are changing this situation. And now private individuals and small businesses can provide their VAT-free services via a platform, and with the economies of scale and network effect, be in direct competition with traditional VAT registered suppliers. So for example, a hotel could be competing with accommodation listings which do not charge VAT on their services. According to the VAT in the Digital Age study, up to 70% of the suppliers using an online platform are not registered for VAT purposes. And since traditional hotels and taxi operators have been obliged to charge VAT on their supplies, there is a clear and increasing VAT inequality, where the new VAT in the Digital Age proposal, it tends to level the playing field. The reason for focusing on those services, passenger transport and hotel accommodation, is that these sectors have been explicitly identified by the study as sectors in which VAT inequality is at its most apparent, in that the accommodation platform model competes directly with the hotel sector, and the passenger transformation platform competes directly with private taxi firms. So also these are the two largest sectors of the so-called platform economy, behind the sale of goods via platforms, also known as e-commerce, which has e-commerce, you know that it has its own rules regarding the supply of goods, introduced in July 2021, the e-commerce package. So to tackle the issues we have mentioned, the proposal for the platform economy, which could come into effect as early as 1st of January 2025, includes the so-called deemed supplier model. Specifically, a deemed supplier regime will be introduced, where a taxable person facilitates, through the use of an electronic interface such as a platform, the supply of short-term accommodation rental or passenger transport. And in these regards, we have the new Article 28A in the VAT directive. Under this measure, where the underlying supplier does not charge VAT because they are, for example, he's a natural person, or they make use of the special scheme for small businesses, enterprises, then the platform will charge an account for the VAT on the underlying supply. This will ensure a level playing field between platforms offering services and other traditional suppliers qualifying as taxable persons. This deemed supplier model is going to be a simplification measure intended to facilitate the collection of VAT in specific situations. And this is typically the case when the intermediary in a transaction, i.e. the platform, is better placed than the underlying supplier to ensure the collection of the VAT due on this transaction. So therefore, the deemed supply rules shall be applicable when the underlying seller does not charge VAT because he's either a private individual or a non-established and non-EU VAT registered person, or either falls under the special scheme for small enterprises. The EU has further clarified that an interpreted rental of accommodation for a maximum of 45 days shall be regarded as having similar function to the hotel sector. Therefore, the supply cannot be exempt from VAT because it will be similar to traditional hotel accommodation. Now, if we see an example, the deemed how the platform, the deemed supplier will work. The deemed supply between the seller and a customer is split into two transactions for VAT purposes. The first transaction is the underlying seller is deemed to have sold the short-term accommodation rental or passenger transport to the platform. Okay, and this supply will be exempt from VAT without the right to deduct, of course. And the second transaction is the one between the platform and the customer, whereby the platform is deemed to have sold the short-term accommodation rental or passenger transport to the customer. This supply will be regarded as intermediary service, allowing for the uniform application of the place of supply rules. Okay. For example, the platform will be responsible for collecting the VAT due on the sale from the customer and remitting the VAT to the tax administration. And this supply should not and will not impact the VAT deduction rate of the platform. As we said, the Commission believes that this will ensure a level playing field between platforms offering services and other traditional suppliers qualified as taxable persons, while not imposing a burden on the underlying sellers operating through the platform. Now, the third pillar, as we've seen initially, is the so-called single VAT registration. And again, we'll see briefly the reasoning behind this change and basically what were the drivers for this amendment. And it's quite obvious and apparent that businesses carrying out transactions taxed in multiple member states face considerable VAT compliance burdens and costs. And this is a big barrier within the single market. The VAT e-commerce package that we have mentioned before and that was entered into force on 1st of July 2021 brought new VAT legislation which significantly reduced the overall VAT compliance burden for e-commerce businesses. And instead of having VAT registrations in each EU member state of their customer base, such rules allow a central registration and reporting of VAT liabilities. We have the one-stop shop regime, the OSS, for supplies to consumers within the EU. And we also have the IOSS, the import one-stop shop scheme for the importation of consumer goods with a parcel value not exceeding 150 euros. So the implementation of the OSS and IOSS has proven so far to be a great success. And a limitation, one of the limitations though, is that the scope of its application is limited and many businesses remain subject to burdensome, I would say, VAT requirements in multiple EU member states. So in these regards, modifications and clarifications to the existing VAT legislation have been introduced under this proposal. And of course, the aim is to reduce the number of cases whereby businesses are obliged to register in a member state where they are not established. In a nutshell, basically, this will be achieved by expanding the existing OSS, IOSS schemes. Secondly, the introduction of a new OSS scheme for transfers of own goods between EU member states, expanding the scope of mandatory reverse charge mechanism, and finally, expanding the scope of the deemed supplier rule for platform operators. We'll see in a bit in more detail these amendments, modifications. First of all, we have the extension of the existing OSS scheme. On the one hand, the existing Union OSS scheme will be expanded to cover also supplies of goods with installation, supply of goods on board of ships, aircrafts, trains, supply of gas, electricity, heating, cooling, and also domestic supplies of goods, and these can also be margin scheme goods. given that these are supplied to non-taxable persons. Okay, so it's only for B2C, let's say, transactions. And as I mentioned previously, the scheme is also extended for certain sales of margin scheme goods. On the other hand, the scope of the non-union OSS scheme will also be expanded to cover supplies of services from non-EU businesses to all non-taxable persons. Okay. Also, the making amendments to OSS returns will be eased, as they can now be made in the same period via a corrective return, insofar as the amendments take place before the filing deadline of such return. However, as currently is the case, the OSS schemes will still do not allow businesses to recover input VAT, and this will be the case as well. So the VAT refund scheme needs to be followed. Now, for B2B supplies, the second, let's say, category, we are going to have a mandatory application of Article 194. 194 is a main provision in the VAT directive, and now it becomes a shall provision, so it's going to be mandatory for all EU member states. Article 194, for those who do not recall what we're talking about, is the so-called local reverse charge mechanism for suppliers non-established. So such option will be replaced with the required reverse charge mechanism for any supply, both goods or services, which are performed by a business who is not established in the country where the VAT is due. So such a mechanism will ensure that in such circumstances, the supplier who is not identified there does not have to VAT register anymore in that EU member state. For example, in Cyprus, we have applied Article 194 only for some particular transactions, supply of goods or services, for example, land-related services. But now with the proposal, this article will be mandatory for all goods and services. Now, the deemed supplier rule for platform operators. The deemed supplier rule for sales via electronic platforms will be expanded to include all supplies of goods within the EU facilitated by an electronic interface, irrespective of where the underlying supplier is established and irrespective of the status of the purchaser. Moreover, the deemed supplier rule will also apply to certain transfers of own goods that are facilitated via an electronic interface. And this will further ease the VAT obligations for EU sellers leveraging selling via electronic platforms. We are also going to have a new OSS scheme for transfers of own goods. As of today, you know that a business transferring own goods from one EU member state to another, there is a need for VAT registration on the basis that we haven't deemed intra-community supply, intra-community acquisition. Okay, we had the simplification rules, but now the new OSS scheme will be introduced and will allow a monthly centralized reporting for any cross-border transfer of own goods by businesses within the EU. as intra-EU acquisitions of goods by businesses applying this scheme will be VAT exempt, this will eliminate the need to register in each EU member state of arrival. And as such, the scheme will also cover transfers falling under the simplification of the call of stocks. The specific simplification scheme was introduced, if you recall, with the 2020 quick fixes. So call of stocks simplification for call of stocks arrangements will be discontinued. I think 1st of January 2025, call of stock arrangements will not be applicable anymore. Well, basically, these are the changes under this VAT in the digital age proposal. They are very bold, very important. If you have any questions, I think we do have 10-15 minutes. Please feel free.
Thank you, Michael. Thank you for the presentation.
Thank you.
From the presentation, Michael, I understand that although the time, the date is 2028, for someone to be able, for a company, for example, to be able to be prepared for that date, it will indeed take a lot of planning and an action plan to be able to have all these digital transfer of information within the community. So although when I saw the 2028, I said there is time, but a good planning is always needed in order to be able to perform during that when the trigger time starts. And the other thing that I understand is that basically there will be a direct access of a company's accounting records within the EU. If I forget I leave aside the domestic legislation within the community.
Yes. Now, with regards to the first, to your first comment, Katia, 2028 is the date whereby the DRR, the digital reporting requirements, will be applicable 1st of January. However, these changes, some of them have an effective date 1st January 2024. For example, electronic invoices is 1st January 2024. So some other amendments, for example, the extension of OSS, etc., 2025, 2026, and then finally 2028. Yes, it's crucial for businesses to get ready. We are going into, as I said, almost real-time reporting. Imagine that businesses will have to report on a transactional basis and submit their invoice maximum within 2 days upon issuing that invoice. So I think the businesses have to start getting ready and prepare and make relevant amendments in their ERP systems and so on.
And the cost of such implementation.
Yes, the European Commission, though, expects that the cost to implement and the cost to businesses will be less than the compliance, the current compliance cost for having multiple registrations and so on. And also, don't forget that their main aim is to combat VAT frauds. So by having on a real time every transaction, you've seen that the VAT gap in 2020 was 93 billion euros.
We're happy to leave it there, and obviously thank Michael for his his exploration of the subject. It was really really interesting and full of useful information, I'm sure, for all of our participants. And once again, a huge thank you as well to Katya for organising this event. Katya has been our champion force for our community in Cyprus for a couple of years now, and it's wonderful to be working with her in delivering services and helping our growing community across Cyprus. So as said at the beginning of the session, we are looking to potentially deliver more of these webinar events going forward, and obviously we'll keep you all in the loop on when the next session is and the topic. And obviously, in the meantime, if anybody has ideas for topics that they would like us to explore with an ADIT webinar, then please do share with us, and we'll look to act accordingly. But in the meantime, yes, a huge thank you to Katya and to Michael, and it's been a pleasure. We hope that everybody has enjoyed today's session.
Thank you. Thank you.
Bye,
Thank
everyone.
you, Michael. Thank you. Bye-bye.